increase has to do with three things. First of all, a bounce back in market share. The market share of precious metals and precious metals related assets in the U.S. market is below 0.5%, down from a 4-decade mean of 2%. So part of this is a reversion to mean. But U.S. consumers, by and large, U.S. investors aren't buying gold. The outflow of gold from the ETFs tells me that gold doesn't have a place in the public imagination in the West. I've learned by grading 80,000 portfolios over 6 years from around the world that the gold constituency is a traditional constituency. When I talk to investors, which I do, in India, Pakistan, Indonesia, Brazil, China, even young investors, and particularly female investors, there's a very strong interest in gold. But the increase in gold price really hasn't come from that. It's come from central banks and governments objecting to the weaponization of the U.S. dollar and understanding, too, that being paid a 4% interest rate in a currency where the true purchasing power of the currency is declining by 7%, that understand the bad arithmetic around U.S. Treasury securities, while similarly understanding that the U.S., for all its faults, is, to quote Doug Casey, the prettiest mare at the slaughterhouse. There just aren't alternatives for places. Well, the Indians don't trust us, and the Saudis don't trust us, and the Russians don't trust us, and the Indians don't trust us.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Rickrule, a renowned market analyst, recently shared his insights on the current state and future prospects of gold and silver prices. He highlighted a significant decline in the market share of precious metals and related assets in the U.S. market, now below 0.5%, down from a 4-decade mean of 2%. This, according to Rule, suggests a reversion to the mean, as U.S. consumers and investors largely avoid gold, evidenced by the outflow from gold ETFs. Rule pointed out the troubling financial situation in the U.S., with a collective debt of $150 trillion and a budget deficit of $2 trillion annually. This, he noted, is unsustainable. Despite the uncertainty surrounding whether the market is in a bubble, Rule stressed the importance of investing in individual companies using fundamental analysis rather than broad market indices.
The answer is I don't know. I'm not an economist. There is a lot of cash on the sidelines, and liquidity often drives markets. Because I'm, at my core, a lender, a credit guy, a green eye shade guy, I joke that I've correctly forecast 17 of the last 3 declines. The consequence of that is I don't listen to myself too much anymore. I have also learned on the other side, Jesse, that if you buy the market, buy a sector, you go broke because it's too broad for you to understand. If you buy individual companies using fundamental analysis and you buy people based on their values and their work ethics, you do well. So it sounds like I'm avoiding the question, but the truth is I'm discounting my ability to answer the question. There are plenty of things about the market in the near term that scare me, because I scare easily. I'm a lender. I don't understand some of the valuations, even despite the growth. I am nervous about a recession. There are companies that do well in sectors that I don't understand, and I don't allow myself to do things that I don't understand. Looking at the other side of the equation, the longest unbroken bull market in history is the ascent of humankind. There have been some pretty ugly punctuations, things like World War II. But I suspect that one must be a long-term optimist while maintaining enough concern and enough cash, frankly, that you can weather periodic events, which is what I try to do.
Well, that leads to a follow-up, which is over the past decade plus, the mantra for retail investors has often been to just dollar cost average into an index fund, into an S&P 500 fund, maybe diversify with some bond exposure and kind of set it and forget it. This is the random walk down Wall Street theory where fundamental analysis doesn't really work, and nor does technical analysis. So just invest in the market, sit back and forget it. Now, I've spoken to several guests on this show, people like Grant Williams, who have said that the paradox has kind of changed now. It's no longer a market environment where you can just passively sit back and invest in an index fund. Would you agree with that? Do you think the market environment has fundamentally changed?
I think if you have a 20-year horizon, you can do it. I think if you have a 5-year horizon, it's very difficult. When I look at the S&P 500, what it really is an S&P 10. The concentration in the S&P 500 is so geared to world-dominating technology companies, and my own lack of knowledge around their technology pipeline is so profound that I don't have the courage personally to buy the S&P 500. In 1982, recognizing my own shortcomings as a general market securities analyst, what I decided to do was make most of my general market securities portfolio consist of one stock, Berkshire Hathaway. The idea that I or many other people that I knew could outthink Warren Buffett was very low. And the fact that Warren Buffett was able to structure Berkshire Hathaway as an insurance company rather than as a closed-end fund, which meant that he could deduct
He remains optimistic about the long-term market outlook, citing technological advancements and human progress. However, Rule advised caution with the traditional strategy of dollar cost averaging into index funds, especially given the heavy concentration of the S&P 500 in a few dominant technology companies. Instead, he has placed significant trust in Berkshire Hathaway, citing Warren Buffett's expertise and the company's tax-efficient structure. On a global scale, Rule expressed concern about significant debt issues, but remains hopeful that individual genius and technological advancements can overcome collective financial mismanagement. He praised the reduction of dire poverty globally over the past 40 years, seeing it as a positive development for global markets. Addressing the recent rise in gold prices, Rule attributed this to central banks and governments buying gold as a hedge against the weaponization of the US dollar.
Anticipated policy loss expenses against current income meant that I had the best stock picker in the world, and I paid an effective tax rate of 11%. That type of analysis is very different than got a hunch, bet a bunch. But it worked for me. There are years when the broad market did better than I did, but it did it with extraordinary risk. And I've decided that you can take away part of my upside if you take away most of my downside, which is why I did Berkshire Hathaway and why I don't do the S&P 500. The S&P 500 as a bet on the ascent of humankind isn't a bad bet, but it's a bet where I don't think that the information is disseminated well enough, which is to say there's a whole bunch of people out there who know more about Microsoft and Apple and Amazon than I do, and I don't want to compete against them.
That makes a lot of sense. I wanted to get your take on both the US and global economy as well. When you look at them today, what are the main points of concern for you? And what, if anything, makes you optimistic? We hear a lot of doom and gloom these days, so I'm wondering if there's anything you see out there that has you positive.
Let's start with the optimism first. Technology. The ascent of humankind is sort of approaching warp speed. The ability, as an example, and I'm not going to give you all the arm-waving stuff about AI, but the idea that with the increase of computer power, that you can analyze really vast amounts of data and look for coincident anomalies means that securities analysts like me, who used to have to spend 50 or 60 hours a quarter doing very broad stock screens themselves can now go to Bloomberg, and Bloomberg will scan the whole universe of publicly quoted markets worldwide and give me the screen in 90 seconds. Bloomberg, for $2,000 a month, saves me 20 hours a month, which is astonishing. And the ascent of humankind is really being fueled by technology. And the benefits of this advance in technology are cumulative and compounding. For all the faults I find in American culture, as an example, it's still a place where a group of youngsters can take over a garage in Sunnyvale, California, and out pops Google or out pops Apple. The second thing that makes me bullish is advances at the bottom of the pyramid. We have done a wonderful job in the last 40 years of moving 1.5 billion people out of dire poverty to the point where they're just poor. Does more need to be done? Absolutely. But what we've done is spectacular. And I think that we will eliminate dire poverty within 20 years. This isn't just good from a philosophical perspective. It's good because the inclusion of 1 billion people into the marketplace makes everyone who cares to become richer, richer. And also exposes us to the talents of 1 billion people that otherwise wouldn't have the opportunity to contribute. This parenthetical garage in Sunnyvale, California, then, might actually pop up in Lagos or Jakarta or Sao Paulo. Thinking about the young people that I mentor through Students for Liberty, now 160,000 of them worldwide, if you visit with these young people, it's very difficult to be a pessimist. The third thing is simply that there's so much liquidity. Now, let's look at the downsides. Liquidity is different than solvency. On a global basis, our societies as collectives owe too much. And the real test will be, will our individual genius and tenacity overcome our collective stupidity? In just the United States, we owe $34 billion on balance sheet at the federal level before state and local debt. But more importantly, through things like Medicare, Social Security, Medicaid, federal government pensions, military pensions, the net present value of our off-balance sheet liabilities, entitlements, exceeds 120 billion. Oh, I'm sorry, trillion. I got the wrong starting point. $1 trillion. So collectively in the United States, before individual, corporate, state, and local debt, we owe $150 trillion. And we're trying to service this with a budget that's in deficit $2 trillion a year. That's ugly math. And our faith in government, our faith in collective coercion is increasing rather than decreasing. That bothers me a lot.
Well, let's get into the commodities portion of the conversation. And I'd like to start with gold hitting and sustaining all-time highs, as you've pointed out, in nominal US dollar terms last time we spoke. Very important distinction. What do you think has led us here? Is this the result of record levels of central bank buying? Are more investors looking for a safe haven in the face of ever-increasing government debt? A combination of all these things, or something else entirely? Give us your take here.
I think
despite the lack of interest from Western investors, there is strong interest from countries like India, Pakistan, and China. Silver, on the other hand, remains less favored, with central banks not purchasing it and Western retail investors showing little interest. Historically, precious metals bull markets start with fear-driven gold purchases, with silver attracting more interest later due to greed. Rule drew parallels between current economic conditions and those of 1967-1982, suggesting a potential for significant increases in gold prices if investor concerns about the purchasing power of the US dollar grow.
and the Persians don't trust us. They still trust us more than they trust each other. And given the fact that we have idiotically weaponized the US dollar, made it less competitive as a medium of exchange, by the way, the ultimate form of stupidity, what we've done, given the fact that these people mouth appreciation for each other but can't stand each other, is we've forced them to begin to stockpile gold to utilize as a medium of exchange, one that can't be weaponized. And I would suggest to you that the whole ascent of precious metals has to do currently with the weaponization of the US dollar. The fact that the appreciation in gold has occurred at a point in time when the nominal interest rate has doubled is extraordinary. And it's testimony to the stupidity of the U.S. executive and the U.S. Congress.
You've pointed out recently that silver is very hated right now, and you love that. With gold's recent performance, silver remains far below nominal all-time highs. Central banks don't seem to be buying it, and your average retail investor could care less, at least in the West. I wonder, what is it now the time to load the boat on silver? And also, going back to what you said in the last comment about gold, do people outside of the West, those same investors you speak to, also have more of an affinity for silver than those investors in the West?
No, in answer to the former question. And that's consistent with prior precious metals bull markets. A precious metals bull market has been, in my experience, always kicked off by fear. The silver buyer is a greed buyer. The gold buyer is a fear buyer. And the precious metals narrative always starts with fear. Now, my belief is, and I think we've had this discussion before, but I'll try to repeat it briefly. My belief is that the hallmark of a retail precious metals bull market is a lack of faith in the maintenance of purchasing power in fiat currency denominated issues. I believe, too, that investor perceptions are set by their experience in the immediate past rather than by history. And we've been through a period, 1982 to 2022, that was very benign. Lower interest rates, relatively strong U.S. dollar, good performance in the U.S. bond market, good performance in the equities markets, punctuated by some severe but brief downturns. The consequence of that is that despite the fact that the hallmarks of the deterioration of the purchasing power of the U.S. dollar abound, people aren't afraid of them yet, just like they weren't afraid in the period 1967 to 1982. It's eerie how similar that is. You might not have been around, and much of your audience might not have been around, but I was coming of age then. We fought the war in Vietnam and lost. We fought the war on poverty and we lost. We tried to fight guns and butter simultaneously, and all we did was ruin our own balance sheet. It took 10 years of depreciating the purchasing power of the U.S. dollar over the decade of the 70s, when we lowered the nominal purchasing power of the dollar by 75%, before we were able to afford our debts. And that process caused gold to go from a price-controlled $35 an ounce to $850 an ounce. The fear is the wrong phrase, the concern, the affinity for arithmetic that investors need to exhibit around U.S. dollar-denominated debt instruments hasn't matured, the same way that it hadn't matured in the 1967 to 1982 hiatus. If it does, and I suspect it will, you won't think much about a nominal move in the gold price from 2,000 to 2,200. You will be looking at a much larger move. Will it occur? I don't know. But I certainly think it's a contingency worth insuring against at its worst, and a probability worth speculating in at its best. And if you see the type of move in gold that I think is warranted because of the deterioration of the purchasing power in the U.S. dollar, particularly relative to the interest rates that are paid now, I think that the move in gold will surprise you in terms of its quantum. And I think if that